Let's get back to oil. Reports have been circulating over the past few days. Reuters reiterating that today, that OPEC Plus is considering an increase in oil production. However, OPEC itself denying that in a post on the social media platform X, saying that the claims were inaccurate and misleading. Let's get more from Rob Thummel, Senior Portfolio Manager at Tortoise Capital. Rob, great to talk to you. Pretty hard to know what's going on inside the heads of those OPEC plus oil ministers, but do you think, could they maybe have just floated this as a trial balloon to see how the oil market would react?
Well, they've done that before, as you know. The other thing, though, that you have to pay attention to, I think, is OPEC probably has some of the best information in the markets, better than any of us, at least better than me, on demand, right? Saudi Arabia is one of the world's largest producers. Obviously, the U.S. is the largest producer of oil in the world, but the OPEC nations collectively have a lot of great data on what is actual demand for crude oil, and if it's been improving, that's one of the fundamental reasons for them to raise production. Because what we do know is that the oil markets appear to be oversupplied, and that has been the reason for the decline in oil prices really throughout the year. And so we will see how OPEC progresses. I think the other thing that is clear is, longer term, OPEC does need higher oil prices, generally speaking, for a lot of these countries to continue to break even at the country level.
What is their game then? Why would they be wanting to produce more oil in a market that looks oversupplied?
Well, that's where I go back to the demand side. Maybe demand's stronger than what people think. I think the sentiment was for some really weak demand. Well, weaker demand in oil this year, as far as oil demand is concerned, not necessarily price. But I think demand's held up pretty well. In fact, probably been a surprise to the upside, at least fundamentally, that the global oil demand has held in and probably grown more than what people have thought. And so that's why we've needed some of this production to be brought back online.
What is your projection for oil over the next year? Do you see a higher WTI crude price?
Well, we think in the short term, we're probably going to see a lower crude oil price, because especially if OPEC brings back even more production and continues to create this supply glut and create an oversupplied market. Because what we do know is when the oil market does see a increase in inventories, you do see then a decline in oil prices. Now, longer term, and that is at 18 months, is at 1 year, that's hard to predict, but we do see that oil prices, we believe, do need to go in the U.S. back to the 70s, to a 70s level, to encourage production to come back and oil production to improve, especially here in the U.S., as well as globally as well. And we're going to need more oil production. We're going to need more oil drilling as well. And not just in the next few years, but obviously in the next few decades, especially as oil remains an important component to the global economy.
Mm-hmm. It is interesting. Obviously, U.S. shale has revolutionized the oil market over the past decade, but the marginal cost of that production is rising. I see Enverus, which is an analytics firm, saying that right now they can produce oil economically, or the marginal cost is about $70 US, but that's going to go up to as much as $95 a barrel by the middle of the next decade. So that would tend to push up global oil prices if the shale can't keep churning it out at the same price.
You're exactly right. These oil producers in the U.S. and in Canada as well become very disciplined with their capital spending, and they're no longer in the game of just growing production for production growth's sake, and to show that they're in the game now of demonstrating free cash flow generation and free cash flow growth, and returning some of that to the shareholders in the form of dividends and higher dividends, and even in the case of stock buybacks. These companies don't have as much debt. Their balance sheets are in much better shape. Mm-hmm. So you put all those together, they can be more selective on when they want to drill and not drill. And so, and if they need a higher price, they have time to get to the price level that warrants and supports the economics to drill for more oil.
I guess, though, the good old oil sands, they are churning out near record highs. I know Alberta production overall just hit a record high. And they don't really care what the oil price is, in the sense that they don't have to keep justifying drilling new wells.
Yeah, well, that's a big difference. Yeah, that's been the great thing about the oil sands. I've been investing in energy 30 years and was there in the early days of the oil sands, not doing the hard work. There's a lot of work, a lot of great people in Canada that are doing a lot of the hard work, but just looking at it from afar. But yeah, they had a low cost of production, and then quickly shale came, and the oil sands kind of got pushed to the side temporarily. But the long duration nature of the oil sands and the fact that you don't have to keep the low decline rates, right? The oil sands are not declining the same rate as shale oil. So environments like this and this type of oil environment, yeah, the oil sands can really thrive, and they are. And there's no doubt there's demand for the oil, right? I mean, the U.S. refining system needs a lot of Canadian oil going forward to continue to support this economic growth in the U.S. as well.
What about your weighting in oil stocks? Are you overweight, underweight these days?
Well, because we have a view that oil prices are going down, we're underweight relative to oil to oil stocks in particular. We do see an opportunity in natural gas that we see the natural gas growth being driven by the fact that electricity is becoming the new oil, and that natural gas and nuclear will be the big drivers of the energy supply sources, both domestically and globally, going forward.
That's interesting. Maybe we could just pop up Tourmaline oil. It just got a downgrade from TD. TD warning that TOU that heavy spending in years to come will limit the amount of return to shareholders, and also warning that Tourmaline is expensive. That's TD's analysis relative to peers. It's interesting. I mean, Tourmaline has been just a touchstone for investors, saying, well, it's the best of class in natural gas.
Yeah, well, natural gas prices are kind of low right now too. So I can understand when you're in commodity sensitive business. We like to focus on the infrastructure businesses because they're not as commodity price sensitive. In these commodities, more commodity focused businesses where the cash flows are much more sensitive to the commodity price. You get these lower commodity price environments like we are in right now. It does result in some of the things that you're talking about, which is make some of the justification of the valuation of businesses harder. Infrastructure a little easier to value because they're more consistent cash flows and better risk adjusted returns from our perspective.
We'd better leave it there. Rob, thank you very much.